One of our findings are in the paper, which I think is a very positive finding, is that self-custodied holders have a lot more influence than those really big collective entities because they can generally act faster. And especially in a hard fork scenario where investors do have a significant amount of power, acting quickly is very impactful. It's very hard to come back from behind than compared to start out strong and then stay strong. And so if there's a hard fork that occurs, people that are self-custodying their own coins can literally act, within the hour, within the day. They can sell they can either do nothing, they can choose to do nothing. That's kind of the default choice, but they could actively, right as soon as it happens, begin selling the coin that they don't prefer and buying more of the coin that they do. Whereas the larger and more complex of an entity that you are, there's a general principle that you're going to have to go through more checks before taking any action on that given hard fork. If you're just self-custodying, you just on the spot can make that call, and the only consequences are for you and those that are financially connected to you in some way. And so you can act quickly and more decisively. And I think that's one of the positive findings from our paper, is that that's actually I'd say anti-fragile aspects of the network. That some of the most committed and smaller entities actually have kind of a disproportionate impact compared to some of those larger entities.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge. In this video, Lyn Alden breaks down Bitcoin's unique anti-fragile nature and how smaller self-custody investors can influence its price more than large entities. Exploring the report analyzing Bitcoin consensus, Alden unpacks Bitcoin uprates, economic nodes, and game theory. Let's catch her up to know more about this fascinating dynamic.
Steve spearheaded it. Like a lot of things in Bitcoin, there are technical and economic aspects to consensus. And so I mainly viewed it through a more economic lens. To the extent that I understand the technicals, I try to understand them enough to know their economic implications, rather than get really in the weeds on the technical side. So I tried to provide economic input to it. And we've been chipping away at it for months. It's been a background project for us. But it's something that, consensus it's a tricky area because it's hard to even define it, at least in terms of how it comes together. You can define it software-wise easier than you can define it socially. So I found the problem fascinating. In addition, part of what drew me into Bitcoin in the first place was the last time there was kind of disagreements around consensus, which was 2017. My first public article on Bitcoin was in 2017, and that was right when Bitcoin and Bitcoin Cash were splitting out. And then so watching that and then watching the aftermath of it and seeing how difficult it is to change Bitcoin, appealed to me. It was kind of like a test of, I already knew Bitcoin, but that was kind of a test to see how it fared. And what I like about this project is we kind of start from a blank sheet of paper. We don't assume that things worked out in 2017 will work the same way in 2025 or there later. There's kind of like how 2017 was different than 2009 in terms of how updates are made, right? So back in 2009, Satoshi almost unilaterally just kind of made updates. And it was so central around him that it just went like that. Whereas 2017 was obviously a much more decentralized, complicated environment. And so we're years in the future, and we also look toward even further ahead and say, what lessons could we learn from the past, and what issues could we see in the future? And so we kind of put this paper together to kind of analyze how does consensus work in the past, how does it likely seem to work now, and what are some of the challenges that could happen in the future if there's some sort of contention around that consensus.
Joe Rogan, one of the most influential podcasters of our time, is not just known for hosting conversations with figures like Elon Musk, Edward Snowden, and Mike Tyson on the Joe Rogan Experience. Beyond his engaging discussions, Rogan has also made a mark as a vocal advocate of Bitcoin, the world's largest cryptocurrency. What makes his relationship with Bitcoin particularly intriguing is not just his enthusiasm for it, but also the incredible growth of his holdings over the years, despite his apparent inactivity with them. In April 2024, Rogan shared his Bitcoin address publicly, sparking curiosity among crypto enthusiasts. A glance at the transaction history reveals a balance of 5.243 BTC, worth $502,011 at today's market rates. What's astounding is that Rogan hasn't moved or spent any of this Bitcoin for over a decade. Back in 2013, his stash was valued at just $1,645, marking a jaw-dropping increase of over 30,000%. Despite this extraordinary appreciation, the holdings have remained untouched since reaching the 5.24 BTC mark in late 2024. This steadfast HODLing has sparked speculation. Some suggest Rogan's behavior reflects deep conviction in Bitcoin's potential as a universal currency, while others suspect he may have simply lost access to his private keys. Prominent Bitcoin technologist Jameson Lott fueled the debate, suggesting Rogan might have forgotten his key. Meanwhile, others like Daniel Burr have proposed that Rogan could donate the Bitcoin to charity, given its substantial value and Rogan's apparent indifference to its growth. While Rogan hasn't addressed these speculations directly, his belief in Bitcoin as a revolutionary digital asset remains evident. On a recent podcast with OpenAI co-founder Sam Altman, he praised Bitcoin as the most promising cryptocurrency capable of achieving global adoption. Rogan's journey with Bitcoin started long before it entered mainstream discourse. He first discussed it on his podcast in 2013, when the cryptocurrency was trading at a mere $123. As Bitcoin now trades at a staggering $95,524.55, Rogan's untouched stash has become a symbol of the cryptocurrency's meteoric rise. Whether it's conviction, forgetfulness, or strategic patience, Joe Rogan's Bitcoin story continues to capture the imagination of the crypto world.
Right. So, I mean, for investors, they're arguably the most powerful group of all the groups. If there's one that has kind of full control in the long run, it's eventually them. And that's especially true for a hard fork. So, for example, when Bitcoin and Bitcoin Cash split, investors can sell the coin that they don't like and use it to buy more of the coin they like. They can also even participate in futures markets if exchanges set them up ahead of a potential fork, which can determine whether that fork even occurs or set up the probability of how that's going to go. During a soft fork, we found that investors, their power is quite delayed. So when a soft fork is being proposed, when it's being activated by nodes and miners, and that whole process, investors are only able to access indirect power. You know, they can fund developers, they can fund advocacy, but their coins are not yet impactful during a soft fork process or lack thereof. And so that's basically one big power block right there. Miners are obviously a pretty big power block. They have the ability to determine what transactions go into a block as long as they're meeting consensus rules. They have the power to implement soft forks. A fairly small set of mining pools could implement a soft fork, even if the nodes don't agree with it. It would be and we'll probably get into that later. That'll be a fragile soft fork. It's almost like a majority. It's a filtering. It's not a fully adopted soft fork. But they have the power to basically either adopt one or not adopt one. And of course, they have a set of incentives. They want stability in the network. They want to maximize the value of what they're mining, and a whole other set of powers and incentives.
Ethereum made headlines with a remarkable 10% surge in just 24 hours, stealing the spotlight as Bitcoin enjoyed a smaller boost. This jump has fueled speculation about the onset of a potential altcoin season, as Ethereum now accounts for over 13% of the $3.33 trillion cryptocurrency market cap. While Bitcoin's 4.4% gain against the US dollar was notable, Ethereum's 10.66% climb underscored its ability to outperform during key market moments. Trading volume for Ethereum soared to $47.87 billion, with major exchanges like Binance, DigiFinex, and Bybit driving the action. Tether was the most popular trading pair, followed by the US dollar and other fiat and cryptocurrencies. Derivative markets also saw significant activity, with $56.5 million in Ethereum liquidations, $47.73 million of which came from shorts, reflecting a bullish sentiment. Currently trading at $3,647, Ethereum still needs a 24.8% rise to reclaim its all-time high of $4,800 set in 2021. Optimism remains high, with crypto analysts pointing to historical patterns. Tony the Bull Severino highlighted Ethereum's potential for another explosive rally, suggesting Ethereum could climb to $7,500 if momentum holds. As enthusiasm for altcoins builds, Ethereum's surge may signal a broader shakeup in the crypto market. And do not forget to subscribe to Bitcoin Zella. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.